When the market rallies on bad news, you know quantitative easing has done its job. The algorithms don't even care what happens to companies anymore. Everything is positive if central banks are dealing easy money. Stocks will rise even when they should fall. Fake markets riding on fake information, keeping everything afloat. I'm so glad the Fed will make sure this party doesn't stop. Or will it? You came here for the truth, so let me unveil that for you. Today we're going to look at the markets. I'm going to show you what happened with a select few financial companies. We're going to take a look at what has happened in order to make the stocks rise. So let's start with the markets themselves. You're looking at the markets on the top right hand side. You're seeing the S&P, Nasdaq, and the Dow Jones all moving into positive territory today. Hey, why not, right? There's no reason for it to go down anymore because everything is just fine. The Federal Reserve is dovish, and therefore there's nothing to worry about in 2019. Let's buy the dip, and buy the dip. You're seeing articles like this talking about the fact that this whole Brexit thing is a non-issue. Let's just worry about the revenues. Let's just worry about the forecasts and the earnings, all the things that really don't matter. Central banks, of course, are moving the markets, but let's pretend that that doesn't exist. Stocks rose on Wednesday as investors cheered strong quarterly earnings from major banks like Goldman Sachs and Bank of America. So we saw those percentages in the previous screen I just showed you, but this right here gets into more of the details as to why they believe these individual stocks have risen. Of course, all of this could change in an instant, but let's not talk about that because that's negative. Then in this CNBC article, they literally give financial advice, which is quite unfortunate, but this is what they want to do. These stocks could surge the most if and when US and China reach a trade deal. So they already priced this into it that there will be a deal and it's going to be positive for stocks. So buy these stocks. This article is written as complete propaganda, and the people that take this in, the people who are buying stocks on a daily basis, reading this type of garbage, should really rethink their entire strategy. If you go in here, they actually tell you which stocks are the ones to buy, and I certainly believe that these are being paid for. There's no way that an individual is going to actually write up this article promoting these stocks and telling you that there's going to be a trade deal when, of course, that would be predicting the future. How in the world can this be said? You can say if they reach a trade deal, but if and when, and you're trying to make it seem like now is the time to get in because obviously they're gonna have to reach a trade deal and so on. You know what? This right here is the thing that most people could not figure out. But here we are, it's in plain sight. But now we turn the page. Both Bank of America and Goldman Sachs, however, reported softer than expected fixed income trading revenues. This has been the case for Citigroup and JP Morgan as financial institutions broadly suffer from investors staying on the sidelines during the fourth quarter market volatility. I have some charts to show you on this. Basically what you're seeing is a different side that the information really isn't projected out there. Oh, who cares about that? Let's just focus on the positive. Let's not worry about all the risks. Let's not worry about the derivatives. Let's worry about what makes the stocks go higher. People don't want the truth. They just want the positive news. But I say, why not just look at kitten videos all day? That's much more positive. There's always positivity in that. You can watch the kitten videos and you could be happy. But if you want the truth, then it shouldn't be a negative or positive factor. You should just be looking at the information and taking it for what it is. Bank of America right now is 7.72% up right now. It's fluctuating. The stock is almost reaching $30. Who knows? In the next trading session, it could possibly get there if we get enough quantitative easing pumping up this stock. You're looking at a market cap, $280 billion. One of the biggest companies around, there's no doubt about that. This right here has been a recipient, obviously, of the Warren Buffett generosity buying into this company here. We've seen what the Federal Reserve has done, quantitative easing. This has benefited the financial industry as a whole, and then indirectly a company like Bank of America can profit from it, okay? That's the way this works. You and I don't get the bailouts, but of course the big conglomerates, the big multinational organizations, they do. Increased capital returned to shareholders on the right-hand side. You're seeing it for yourself. Bank of America, congratulations. All of that money sloshing around in the financial system ends up coming back to the shareholders. Congratulations. But wait a minute. Gross repurchases. That's right. Stock buybacks have been a major contributor to what we are seeing right now with Bank of America stock, with all of these other companies as well. We're talking about over $1 trillion worth in 2018 alone. Nobody wants to focus on this information, but quite frankly, this is part of the reason why this is happening. And of course, you got a lot of money sitting around and you're not willing to invest it. You're not willing to give back to your shareholders, and so you do stock buybacks. Of course, this was a very, very big problem for a lot of these companies that bought back their stock at the record highs, and then they came down by 20%, by 30%, and they saw what a big mistake stock buybacks were. But that's not going to stop them from doing so. Look, you can give out mass dividends and get people to buy into your stock, but they don't do so because that doesn't benefit those individuals who want to cash out, who are the high-level individuals that are here. That's just the way it is. So let's look at this next one. The font is pretty small in this one, but the Goldman revenue by segment, you can see over the years, basically since the fourth quarter of 2009 up until the fourth quarter of 2018, and one of the most profitable sectors here has been the fixed income, and not anymore for Goldman Sachs. In fact, it's very difficult to see for you, but you're looking at $822 million. You can see that this has declined over the years. In fact, it's the worst since the financial crisis. We're focusing on the red bars here, and you could see how it has changed over the years. That's been a big problem for them. Now, in more recent history, you've seen Goldman Sachs stock actually decline. I believe at the peak it was approximately 40% from its highs. So that's not good when we're looking at it during a time when there has been maximum quantitative easing. We're talking about $15 trillion globally. The Federal Reserve admitted to about $4.5 trillion. There's a lot more, of course, but to what they admitted to, $4.5 trillion, and still these stocks are performing terribly. They have every reason, every possible reason to be rising higher every single day because of all of this funny money that's running through the system, and yet here we are. So that's what we're looking at. It is a big sham, but of course this is what you get. Now you can see this information in a different chart. This is from Goldman Sachs. They provided this report as they do so, and you could just see how this has declined. The net revenues in the bottom left corner over the last few years. This has been a problem for Goldman Sachs. Their stock has been suffering as well. But of course, the real reason here is all about the injection of cash. It's all about quantitative easing. It's all about funny money printed into the system. And in this case, I just did a video about it yesterday. China's central bank just injected a record amount of money into the markets to prevent the collapse. This is what happened. This is a fact. I was criticized, as you can see in the comments section. But unfortunately, this is what people don't understand. It's that this information has been made public. They want people to feel good about it, but you should actually feel strongly negative to this type of data. It shows you that the market is extremely weak, and yet quantitative easing is trying to keep it alive. You don't need quantitative easing when the market is doing well. You don't need that when the economy is doing well. You don't need public works projects when everything is fine. This tells us that everything is not fine, that we have many problems that are existing today, and they're trying to cover them up in every way they can. They reduce their lending requirements. They make it easier to get money. They engage in quantitative easing. They provide any sort of stimulus to the economy, to the markets, in order to keep it propped up. This has been going on now for 10 years, and yet we are still here, still talking about this. Many people believe it can go on forever, and if they want to be delusional, there are a lot of Disney movies that are available that give you that sense that everything is just fine. There are so many. There are classic fairy tales that you are able to watch the movies. Maybe you want to read some books on that, fiction books that make you feel good, but that's not what this is about. This is about the truth. If you're not willing to deal with that, that's fine. Look, people say there's a lot of fear, there's a lot of sitting on the sidelines because you're missing out on this great, wonderful opportunity. Isn't that how it always is presented to you? That this is the next great thing, that you're sitting on the sidelines, you're not able to profit from it, and you're going to be losing out as a result. I assure you, this is not the way it works. The individuals who are in the highest authority monopolies, they don't look at it this way. They are in a completely different state than you. These individuals control these monopolies. They have the conglomerates on their side. They are able to determine what rises and what falls, and I'm sure they are not worried a single moment about you and your savings and your investments and the things that you do. That's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. All you have to do is click that one button, and that's it. That supports me. If you want to comment on the videos as well, of course, that is helpful also. And if you want the financial education that you were not taught in school, these 2 books have everything that you need, from the foundation, the history, the asset classes, how to make money, tax incentives. There's really a lot more than that in these books. Check them out at the link where you'll be able to flip through the pages for yourself. And if you're more interested in the audiobook, you can get that at themoneygps.com.